This is some China research that was published today from MRB Partners, Macro Research Board. So do business with them if you're an institution. All right, so stock rally still in early stages. We agree. This is the average newly built home prices inverted. So they're just bottoming here. You can see this is the CSI 300. This is the 12-month forward earnings for MSCI China versus the MSCI China. You can see that earnings have bottomed. We showed you the Alibaba earnings estimate chart last week. So the earnings are doing it, and it did the exact same thing back here before that monster run in 2020 where Alibaba peaked at $319. Is earnings turn, the market turn. So you get the market turn, you get the earnings turn, and then it just goes straight up. So we're excited about that. Then you got new monthly purchases of equities. So you are seeing inflows, Stock Connect inflows, and is in green, and ETF inflows is in the dotted brown. So that's positive to see. And what's leading is consumer discretionary leads the earnings rebound. That's Alibaba, ladies and gentlemen. So we're excited about that. Next, we've got, what is here? Repo operations, foreign holdings, government bonds. We'll skip that. Yuan bonds are starting to outperform. That's a key sign to health in the market. Currency tailwind. Softer dollar, much stronger yuan. That was our entire thesis was predicated on the dollar weakening. It sold off 10% in the last couple months, and Alibaba's up 80%. What else do you want to know? And it's funny because I put that out on the day that everyone was panicking and puking in the hole, and we said we're stepping in and we're going to increase our position by 10%. We didn't get $58. We got $61. And we put an 18-point post on Twitter, which we also made an article out of. You know, the key is in this business, if you want to be great, is number one, you got to do your work. Because there's no way you can have conviction if you don't do your work. Otherwise, you're just a moron and you're going to lose a lot of money. But once you've done your work and you're buying high quality businesses, when life serves you lemons, most people, you know, spit the lemon out and they miss the opportunity of a lifetime. We consistently and systematically traded out pawns for queens, meaning we would look at what was in our portfolio that couldn't be a 3 or 4 or 5 bagger that we could sell out and buy more Alibaba when the market was acting absolutely irrational and absolutely crazy on every single COVID headline and G headline and complete nonsense and BS and noise that had nothing to do with the underlying quality of the business and the moat and the 38% share of AWS and the 1/3 ownership of Ant Financial. And we kept saying it over and over, and the stock price kept doing what it was doing, and everyone would be crying and raising their arms and, you know, blah, blah, blah. And you know what my clients were doing? They weren't crying and raising their arms. They were calling me up and asking, did you buy more? Did you buy more? And that's why I choose who I work with, the types of partners that I work with who are exceptionally wealthy, because they got wealthy not by puking out the lemon, but by making lemonade. So when they, you know, whether they've made their money in real estate, whether they've made their money in rolling up companies, whether they've made their money in anything, the common denominator is very simple. They all, in one way or another, bought quality when it was on sale, when no one else wanted it, and sold it when everyone wanted it. That's it. And just over and over, across industries, across wealth, you just see it over and over. There are your exceptions where people invent something and get rich that way, but by and large, it's this same mindset that creates real wealth over time. Ignoring the crowd, doing your homework, and that's when you can step in. And you know, it's not stepping into stocks that are earning no money just because they got 10 points cheaper, because they're still crap stocks earning no money. So that's what people miss, and that's why people get burned and have to learn. And most of them never actually make it back. As a matter of fact, there's an article. Here we go. This is it right here. Rookie traders are calling it quits, and their families are thrilled. Many who picked up investing during the pandemic are cooling on the hobby. And this is the sign of the bottom, ladies and gentlemen. This is the stuff that you see at the bottom. But by and large, it's buying high quality businesses when they're on sale. And everyone I've dealt with that comes to me that it's worth over $100 million, it's the same common denominator. took advantage when something was out of favor of quality. They did it. They waited. They had patience, and that's why they're in the 1/100th of 1%. Okay. More on China here. Let's go through the economic surprise index. So this is where it bottoms. The exception is during the pandemic, but GDP growth will recover to 5% this year. We're in that camp. They set the targets. Now they've got the country open. It can actually happen. You see the services and all these things bottomed out in December before they finally blinked. And by the way, if you think politicians don't blink, right now Powell is exactly what Xi was in December. He'll never come out of COVID zero, blah, blah, blah. And then sooner or later, the pressure becomes so acute that they have absolutely zero choice but to blink. And we're going to cover that in one of the articles, what made Xi blink. And it just goes to show, and I talked about it throughout the year, the 100 families, blah, blah, blah. If you don't change, they're going to change you. And sure enough, the riots happened, and, he had no choice. Okay, so there's a lot of good information in this report. And you just see the Bloomberg credit impulse. So again, it's turning up just like in 2018 to that 2018 to 21 run. Now we're seeing the credit impulse. We've been talking about all the stimulus. We didn't see it in price. Now we're seeing it in price. This is a big deal. You just watch credit. That's the whole entire story. M2 money supply. Look at this. While ours is at the worst year on year, look at what's happening in China. The M2 money supply growth year on year is bigger than it even was in 2020 when the market was rallying. So, and total Chinese yuan deposits percent year on year. So this is fodder for an enormous fire in a good way, a blaze of action that's going to be happening. Even look at retail sales. Online retail sales have been going up. Okay, this whole period, they went off a little bit. Auto sales peaked over the summer, sideways. They'll go back up now. Then you got online retail sales really ran back up into November, probably a little bit in early December, and with COVID. But these are going to make new highs again. And that's what we do. We burden ourselves with data, not emotion, not headlines, but actual data and what's taking place. Epic dollar okay, so here was the whole thesis last year. We showed you the commitments of traders hard. We said the dollar was going to roll over. We said it was the most crowded trade. We showed you the Bank of America data. Everyone kept saying dollar higher, 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 higher. A little bit early, but you stay patient. When you know what you're doing, you stay patient. You increase the position into the opportunity that the market serves up. Now, sentiment has changed. Epic dollar rally goes into reverse, and investors expect further declines, which means we probably get a counter trend rally.